Hi, everyone. This is Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter, and joining me are Ted Bauman, our editor, and Clint Lee, our research analyst. Clint, I wanted to give you a quick shout out. Congratulations. You just closed your 14th winning trade in a row in Flashpoint Fortunes. You are 14 for 14. It's incredible. So congratulations, Mr. Bullseye. But unfortunately, it's not all good news today because the markets have been in a bit of disarray. We've been talking about it in Bauman Daily. Ted, I know you covered this in your Friday video. Interest rates. We're seeing bond yields going up and stock market and investor confidence going down. So today, let's take a close look. Let's see what everyone is freaking out about. Should they be freaked out? And Clint, let's just start. What exactly is going on?
Yeah, sure. I mean, so, we've had this drawdown in stocks that's been in progress, and everyone's talking about the impact that interest rates is having on it. Interest rates really impact stock prices in two different ways. One is just sort of the competition for investor capital. You may have heard the acronym TINA being thrown around a lot, TINA. There is no alternative. And that's because for the longest time with rates sort of across different fixed income maturities so close to zero, there really wasn't a great opportunity for investors to earn returns other than in the stock markets. That forced a lot of money into stocks. But as we've seen this back up in yields, the 10-year is back up to 1.5% for the first time in a while. It's above the dividend yield on the S&P 500. So bonds are starting to become more attractive to investors now, and it's taking some of those resources, some of those dollars that have been allocated to stocks, drawing them back into the fixed income market. So that's one way. Now, the other way is how interest rates work in valuing businesses. So the value of any business today is all the earnings you expect it to make from here on into the future, but discounting those earnings back to the present, and you discount them using an interest rate. When interest rates are low and falling, that's good. That helps boost that present value figure. But when they're high or they're rising, and that starts to negatively impact that present value factor. And that's especially true in the growth space. A lot of growth stocks, they're growth stocks, and they don't have a lot of earnings right now, or they have negative earnings right now. It's because they're expected to sort of monetize whatever it is they're doing in the future down the road. And the further out those earnings are occurring, the bigger the impact from that rising rates to that business's value today. So let's just take a look really quick at a couple charts that illustrate, sort of the severity of this backup that we've seen so far. So the first chart I have for you is a 10-year treasury yield. This goes back about 10 years, and I wanted to highlight how important that this 1.5% level has been over time. For the longest time, rates would fall down to that 1.5% level, and they get turned back higher. We've seen that in several different instances over the last, once again, 10 years. But then, most recently, the circle on the right-hand side, that was during the pandemic. As the pandemic set in, we finally broke below that 1.5% level, and that sent yields plunging. We eventually bottomed out around 0.5%. But you look at what's happened recently. Part of this is rising yields, but part of it is also how quickly they've risen. So for this 10-year treasury to go from the last time it was at 0.5% back up to 1%, that took about 5 months. But for it to go from 1% now up to about 1.5%, that's happened in about the last 4 weeks. So not only are yields rising, but it's how quickly they're rising. And I have one more chart just to show how severe sort of the drawdown in bond prices has been. Now, this actually uses an ETF. TLT is the ETF. This is an ETF that holds U.S. Treasury securities further out on the maturity range. They're 20 plus year bonds in here. And this comes to us from macro charts. And what this is showing is the price of the ETF in the top panel, but then its drawdowns or its declines from a high watermark in the bottom panel. If you just look at the right-hand side, you can see from earlier in 2020, the last time this ETF peaked out, we're now down over 20% on this ETF. So that's once again flagging how much rates have risen. But this chart goes back 20 years. And so you can compare this drawdown to what's happened over the last 20 years, and you can see it ranks among the worst that we've seen. So that's the impact of why this is having such a negative impact on stock prices here.
Right. Now, Ted, in your Friday video, you discussed the Fed and some of the options that it might have to force interest rates down.
Mm-hmm.
But I guess the big question and everybody's concern is how bad could things get if they don't do that?
Well, yeah, I mean, I was just thinking, while Clint was talking, it's like I didn't realize that most investors actually worried about valuations over the last year. It seemed like that was the furthest things from their mind, but they do matter to institutional investors, and we forget that they also drive the market. So that's a big factor here. And on that score, I don't think the Fed really would want to drive interest rates down. They don't have a compelling reason to do it, even at 2.25%, which is the long-term, that sort of 10-year average. That's not a particularly high price to pay for money. So I don't see the Fed doing this unless things get really out of hand, and I can't see that happening under these circumstances. Bond rates are not going to go really high unless there's some sort of a liquidity crisis. In which case everybody is trying to sell them at once to get cash, and then you can have a problem. I don't see that on the horizon. But the bottom line is, everybody was saying last year, don't fight the Fed. Well, what are you going to do now? I mean, it's not the Fed that's driving the interest rates up, but they are going up, or at least the signs are that they will. So what are you going to do? So let's just start with a chart that shows just how much money has flowed into the market over the last year, ostensibly on the basis that the Fed was keeping interest rates low. Everybody told us last year, whenever we did a video, you can't fight the Fed, low interest rates, let's all go into stocks. Well, they did. So what's the consequence of that? So the next chart I'm going to show you is the S&P 500. That blue line is the cyclically adjusted price to earnings ratio of the S&P 500. I've drawn a trend line. And I've also drawn a red trend line that shows the rate of increase since that sort of super low interest rate environment started. And stocks have just taken off like a rocket. Everybody knows it. Now, the big question is, what happens to that if it reverts to the mean, if it goes back down closer to that dotted line, which is the trend line, which could happen, based on rising interest rate yields. You can see that there's a direct correlation between those very low yields and the stock market. Well, my calculations show that would be about an 18% drop in the value of the S&P 500, at least on a price to earnings ratio, if that were to happen. Now, it's possible that earnings will rise, and so it won't be as big as 18%. But all of the things being equal, we could be looking at a close to 20% drop in the S&P 500 if we have sustained 10-year yields over 1.5%. Next chart shows the Nasdaq 100 versus the 10-year Treasury yield, and that's even more steep. I mean, basically the rise in the Nasdaq 100, the top tech stocks over the last year during this super low interest rate environment has just been way out of kilter with everything else. It's like we went back to the late 2000s. Now, the drop here could be as much as 33%, according to my calculation. So you're looking at the potential for a 1/3 drawback or drawdown in some of the biggest high-flying tech stocks. And you can see that anticipated in this next chart, which shows the ARKK ARK Innovation ETF, which is everybody's darling the last year. Look at that upper right-hand corner. Look at that drop, that red drop. That's people fleeing from that ETF. Almost $500 million worth of outflows from that ETF just on February 23rd, 3 days ago. So that's a pretty big drop. So that tells us that this is a trigger point, and if we cross it, we could be looking at 20 to 30% drop in the highest flying stocks. Not all stocks, but the highest flyers.
We got a question a couple of weeks ago, and one of our viewers asked if I was an investor. I am an investor. I am not an expert, but my strategy when things get tough like this is to not look at my E-Trade account. Now,
it's good strategy.
Clint, you're a CMT, a chartered market technician. You're a former fund manager. I imagine you have some better ideas for our viewers on what they can do right now.
Yeah, I mean, go look for opportunities on the pullback. And I would start with why are interest rates increasing and work your way backwards from there. Well, interest rates are rising because of inflationary fears, and inflationary fears are creeping up higher because of just all the stimulus that's out there. And we had over $3 trillion in stimulus last year, another $1.9 trillion in stimulus that they're working on right now. Maybe we see a $1 trillion plus infrastructure package after that. And then you've also got the economy, set to reopen with the vaccine efforts now well underway. Hopefully we get the J&J approval for use here soon as well. So just all these things coming together and what that means for activity in the economy. So I would look at, the areas that can leverage that, because I think, Ted, you made a good point in your Bauman Daily commentary this week on how, inflation, the interest rate impact is negative for stocks, but inflation and rising prices, that can rise and increase the sales and earnings of companies as well. So I look at who can turn all that stimulus into higher sales and higher earnings. And I look at the recovering sectors. I look at areas like the airline ETF with JETS, JETS, or the oil exploration and production with XOP. Look at these service type sectors or ones that play into that service type sector, and the cyclical plays. Those are the ones that will be able to leverage that stimulus to further their recovery. And those are the ones that aren't trading at ridiculous valuations. They still have yet to recover the drawdown, the declines that happened last year.
Ted, what are you looking at? Well,
I think there are a number of different opportunities. One, I just want to highlight because it's something that's very popular with us here at the Bauman Letter. This is a chart that shows the relationship between a REIT index, real estate investment trusts, and the stock market after the big crash in 2000. Now, I'm not suggesting that we're going to see a crash necessarily, but the key thing is you're looking at stocks that have secure cash flows, right? That's the fundamental shift. And instead of growth stocks that maybe will make money someday, that everybody's happy to speculate on because money's free, when money has a price, then you want to look for companies that are generating money and on a secure basis. So REITs is one that I would certainly look to, which is kind of contradictory because as interest rates go up, you would expect REITs would be less popular. But their yields are still significantly better than most other classes of equity. So I think REITs is a good play going forward. And plus, you're going to lock in that income. I mean, our yield on cost for our endless income portfolio in the Bauman Letter is significant. It's almost 3 times as high as the S&P 500. And that's something that's going to happen regardless of what's happening to interest rates. And it's probably going to rise as these companies raise their interest rates, which most of our picks have actually done. So that's the one thing. The second thing is I wouldn't discount growth stocks. I think the critical thing is look at the realistic growth stocks. Clint pointed out this concept of GARP, growth at a reasonable price. Don't give up on the EV sector or renewables, the technologies associated with that, communications technology. Those are still coming, but you don't want to pay more than you have to for them, and you don't want to gamble on them, Reddit style at this point. You want to actually be looking at companies that have a genuine plan. So we've got a couple of stocks, for example, in the Bauman Letter that we've chosen recently that have taken a bit of a hit because everybody's taking a hit right now in the tech space. But if you look under the hood of those companies, they are positioned to actually make cash flow money very, very quickly. They're not speculative, they are actual operations. So I would take advantage of the dip and buy those companies. What I wouldn't do is buy companies that have already priced in all of these future years of earnings in their prices and can only go down from here. So my tagline here is forget Zoom, invest in the boom, because we are going to be getting, as Clint said, big inflows of money into companies whose earnings are going to go up. Buy those companies. Don't buy the companies whose earnings have already been priced in and can only go down from here.
All right, well, you heard it here first, folks. Forget Zoom, invest in the boom. Thank you so much for joining us. And if you would like a peek at how Clint's Flashpoint Fortunes works, Mr. Bullseye, click the link above or below. We'd love for you to join us. Thanks again.
You're going to be the Hank Aaron of options traders. Let's see if 738 is it. We'll see if we can do that.
Thanks again.
Cheers. Bye.